by Ghamari, Swiss thought leader in real estate. Monetary policy, a tool wielded by central banks to manage a nation's economic health, has profound repercussions across sectors. One such arena where its effects are keenly felt is real estate. At the heart of this policy lies interest rates, the pulse rate of economies. This article delves into the intricate dynamics between monetary policy, especially interest rate fluctuations, and the property market. Understanding monetary policy. At its core, monetary policy refers to the set of strategies and actions taken by central banks to regulate the money supply and interest rates in an economy. Its goals often revolve around controlling inflation, stabilizing currencies, and fostering employment. Interest rates, either reduced to stimulate borrowing and spending or elevated to temper inflation, are the primary lever through which these objectives are pursued. The direct link to real estate. Mortgage affordability. The majority of property transactions involve some form of borrowing, typically through mortgages. As interest rates decline, mortgage rates usually follow suit, reducing the monthly payments for potential homebuyers. This enhanced affordability can lead to an uptick in property demand and, subsequently, prices. Investment attractiveness. Lower interest rates often mean that traditional saving methods, like bank deposits, yield lower returns. This pushes investors to seek better returns elsewhere, and real estate often emerges as an attractive alternative. Consumer sentiment. The psychology of markets cannot be understated. Lower interest rates can boost consumer confidence, leading to a willingness to undertake long-term financial commitments, like buying property. Conversely, rising rates can induce caution, dampening demand. Construction and development. Developers and real estate firms rely heavily on borrowing for their projects. When borrowing costs are low, there's an incentive to initiate more projects, potentially increasing the supply in the market. The ripple effect on property markets. Rental markets. When high interest rates make property acquisition less affordable, many potential buyers might opt to rent instead, leading to increased demand in the rental market. Refinancing opportunities. Homeowners may seize the chance to refinance their mortgages at lower rates, freeing up disposable income which can indirectly support other sectors of the economy. Foreign investment. Global investors constantly scout for favorable investment climates. Regions with favorable interest rate regimes combined with healthy property markets can attract foreign capital, further boosting demand. In conclusion, monetary policy, and its resulting interest rate adjustments, is akin to turning the dials on a complex machine. The resulting oscillations are felt strongly in the real estate sector, with each tweak influencing buying decisions, investment strategies, and market sentiments. For industry aficionados like Ghamari, the dance between monetary policy and real estate is a testament to the interconnectedness of global economies. In this intricate interplay, understanding the nuances of central bank decisions becomes paramount for anyone aiming to navigate the ever-evolving landscape of property markets successfully.